Welcome to our Leaders in Housing Counseling call. We are got a jam-packed agenda, so we're going to get started right away and cover as much ground as we can. So we're going to do a quick update on what's happening with Congress on housing counseling funding. We have, as we shared with the group, the white paper now on RESPA and housing counseling. So I'll mention a couple of things on that and the recent meeting we had with the CFPB, but this is a big step forward, very helpful. We are planning our National Leaders in Housing Counseling meeting. I know people have been asking me, and thank you for that. It's coming up July 26th and 27th in DC. Limited seating. We'll tell you more details about it in future calls. Mentioned it briefly today. But mark your calendars and come on down if you want to really get involved in advocacy. And then we're going to do just a quick mention about this great meeting we had in San Antonio with the MBA and the realtors and counselors and NAHREP, really trying to build a local market similar to the Cleveland one. Just do a quick mention on that. And we're going to spend most of the call with Pam Marin and from who was a mortgage broker in Southern Florida, and also on the advisory committee for housing counseling, and with Ellie Pepper from Empire Justice Center about this opportunity that they have identified around people who have short sales, deeds in lieu, and now it turns out modifications as well, where they are being treated as if it's in a full foreclosure rather than in a short sale, which means that they have a much less time to, a much longer time to wait before they can buy, and people are falling through the cracks that we think housing counseling can help for. So very helpful part of all this. And we'll give you, and also I'm going to add one more thing, which isn't on the agenda, but just a reminder that we have another call next week on the 20th. And this is a fascinating opportunity that is really one of these kind of innovations that could be very helpful to everybody's business. And it's Brownsville, the CDC of Brownsville, Texas, which is a long, well-respected organization, an NABWorks chapter. And in our innovations in housing counseling, they're one of the ones that quickly rose to the top. They have created a program that's it's an alternative to payday lending, and it's basically a short-term loan, a small loan for people. And it's a platform that they are now, that they've developed in Texas, but are now adding more states, and housing counseling agencies can be the vehicle for them. The product is marketed through major employers as an employee benefit, and the repayment is done through from a payroll deduction on the employee. So you solve many of the problems that loan programs have like this. They've really thought through a lot in terms of how to market and present this. And we're kind of at the very beginning of it. And so we will have two of their leaders talking about this on the call next week. But it's very exciting. It's because there's only a limited amount of work that the counseling agency has to do. A lot of this has been thought through already, and it's one of these things where we're really thinking, how can agencies really increase their income flow? So with that note, let's jump onto the agenda. So Matthew, tell us what's happening on federal funding these days.
Yep, so I'll just quickly run through these. So for federal funding, I think folks know there's FY 2017 that's happening, and kind of simultaneously FY 2018 is happening, so just touch on them both quick. So Congress is currently at home on recess for this week and next. When they get back the last week of April, they're going to have 4 days to pass funding to continue funding the government for FY 2017. So the kind of options are they could pass actual appropriations bills, which I think there's some optimism that they are close enough to being done with at least some of them, including THUD, that they think they may be able to pass, packages of maybe 4 or 5 spending bills, and then do continuing resolutions for some of the other programs. If they're unable to actually pass budgets, which has historically been the case, it's possible that they could just end up doing a CR for the rest of 2017. I mean, it seems like a remote possibility, but there's been some pressure from the right to include some things in any funding bill that would basically be what the Democrats are calling poison pills, which would keep the Democrats from supporting it and could, in theory, lead to a shutdown. The Republican leadership has been pretty vocal about the fact that they're not going to let the government shut down, and they seem inclined not to let any of these poison pills in, things like funding the border wall. So that seems like not in any way likely possibility, but it's just kind of is in the realm of possibility. So hopefully, though, they come back, wrap up 2017 the last week of April, and kind of they've already started to get going on 18. We did the Dear Colleagues letters. Congressman Conyers and Senator Menendez led Dear Colleague letters. So now it's the next step will be the administration submitting their budget and their full budget, not the skinny budget where they actually are asking for specific funding amounts for programs. So we'll know what that is in May, and then appropriators will really get going on 2018. I think that's all I want to say about funding. Bruce, do you want to add anything?
Oh, you got it.
All right. So the other thing we wanted to mention quickly is because Congress is home for the April recess, there are a lot of town hall meetings. So this is a really interesting opportunity for folks if a member in your area is doing a town hall to get out and talk to them about funding for housing generally, and specifically about funding for housing counseling. So I did want to just show folks quickly. So the two ways to find town halls. One is to just go to your member's website. But also, there may be a member who you're just outside of their district. So this is a pretty cool website called townhallproject.com. So you can go and, just check out your area and see where town halls are happening in your area. They also then below, well, that may not work because I'm clicked into that, but below there's a listing by state for meetings that are happening. So that's another way that you can find it. So if there's town halls happening in your area, it'd be great if you can go. Let us know if you're going to go, and we can work with you to come up with a question. But I think the message would be that it's really important that you support as high a funding number as possible for HUD. That the proposed cuts in the president's skinny budget would be unacceptable and would be devastating to important housing programs in your area. Talk about the great work that your organization is doing, and say we really need that housing counseling funding has been it's cut pretty substantially with the loss of NFMC, and we really need an increase for HUD housing counseling. But again, we'll be happy to if you're going and want to talk with us and work through what the question might be. We'd be very happy to work with folks. Someone asked when Congress resumes. So the date I think is the 23rd or the 24th. It's a week from next Tuesday, 2 Tuesdays from now. Bruce, did you want to add anything there?
No, you got it.
All right.
Great. So then very quickly, we circulated the memo on the CFPB meeting that we had a couple weeks ago. NeighborWorks, Home for USA, Minnesota Homeownership Network. I'm leaving people out here. Homeownership Preservation Foundation. We had a kind of a broad range of groups that were involved in this. Faith Batista from National Asian American Coalition. And the whole idea was that the CFPB was going to give us an oral explanation of kind of what we should look out for in terms of RESPA compliance and how it might work. And there, as you know, CFPB is under a fair amount of attack right now, and there's a lawsuit that the PHH lawsuit, which part of it is an attempt to change the leadership at the CFPB and weaken its structure. But part of it also involved RESPA, and so they were limited in what they could talk about because of the lawsuit. But it was actually a terrific meeting in the sense that the CFPB went out of their way to say that they really value the work that housing counseling agencies do and understand the kind of critical value that is provided. They mapped out, which is done in the memo, they mapped out the a lot of concerns mainly about exclusivity in agreements that we have with lenders. So you can certainly have agreements with lenders, but you can't say all the cases have to go to this lender, or that this lender has to be one out of 3 or 4 on the list of approved lenders. It can't be locked in that way. But on the other hand, there aren't any sort of sets of rules that say it has to be 5, it has to be 3. The whole idea is that more is better, and things that show that it's that the choice is around consumer interest, consumers' interest rather than the basis of the fee. That is the driving force there. And the helpful thing here was that it's sort of really clearly put out that the CFPB was supportive around the idea that fee-for-service arrangements can work, and trying to provide some guidance on it. The other interesting thing is that the head of enforcement said, you know, we're driven by where we get complaints. We have gotten no complaints about nonprofit housing counseling agencies, and we have no plans of doing enforcement actions on around this issue of the fee for service. So I think those two things together, both the guidance that CFPB provided orally and the fact that they're really not investigating, is both things I think that really strengthen our hand in being able to reestablish these relationships with lenders. One other thing to just say is that the CFPB wasn't able to do something in writing. They only would do it orally, but HPF had established a relationship, a pro bono relationship with Buckley Sandler, one of the largest banking law firms in the country, deeply respected, and they had worked closely with the CFPB on this, and the memo that came out was written by Buckley Sandler for HPF, but HPF wanted this to be available to everybody. So this document you can use and certainly use internally in your organization, but if there's a question with any lender, you can hand them this document and say, well, this has sort of been worked out, and here's how it works. So, you know, thanks to everybody who worked on this. There were a lot of people who did, and on many levels, and I know there'll be more work to come in the future, but this is, I think, kind of the big step forward that helps move this issue along. I'm going to really quickly just mention that we are also going to have our national Leaders in Housing Counseling meeting, and it's going to be July 26th and 27th. It's a Wednesday and a Thursday. We are on the top floor of the Realtors building. It's a magnificent space overlooking the Capitol building, and it's going to be limited seating. So we have a maximum of 70 seats, and that's squeezing it. So we won't be quite as big as we normally do these things. So if you're interested in coming, please, we don't have the reservations out yet. We have a few logistical things to work out, but they'll probably be out next week, the following week at the latest. If you're absolutely committed to coming, please register and get your seat in the room. We are going to do a lot. We're going to do a lot with policymakers. We are going to have a meeting with mortgage bankers and with the realtors around this whole outreach program. There are a few lending programs that are coming to a head. We hope we'll be able to both highlight and help shape. This will be a very busy, productive 2 days. And if you've come to some of ours before and had a chance to go to the dinner and drinks afterwards, we are on Wednesday night, the 26th. We will have the penthouse suite, as it's called, from Bank of America that overlooks the Treasury building, and they'll have their usual wonderful food and drink, but it'll also be a networking opportunity. And you know, there'll be a lot of excitement around this. This will be great, but we'll roll out more plans in the future, and you'll have a chance to register and get onto it. Another quick thing is that the San Antonio, we had our meeting in San Antonio of, oh, there's the crowd right there. It was a terrific meeting with one of these series we're doing of local markets really trying to develop a working relationship between local lenders, real estate agents, and counselors, with the idea that the counseling become the focus of homeownership programs. And they ended up with a very ambitious agenda. They're going to put together an event, at least one. They've got an advocacy committee that's going to go to their housing summit. And they had a whole discussion about how to get in front of the flippers, the people who, the investors who are buying, cash buying houses. San Antonio market prices are jumping up, and very difficult for low and moderate income people to find affordable houses, and in a market that's not as crazy as many of the East and West Coast cities, but it's just kind of pushed out of reach of where people are at currently. So the idea was, can they develop some relationship with these investors to get in front of the deals and get them to low and moderate income home buyers in a reasonable at a reasonable price. And we'll see what we learn from this, if they answer some of these questions that we could all use. So they're going to do a lot of good things there, and the first one was in Cleveland, and we've got a couple more, one in the Boston area and one in California to come, and then we'll talk about this all at the national meeting and make a plan for the rest. So that was a 90-yard dash, but I wanted to leave as much time as we can to our guests. So you know Ellie Pepper. She's been on our call a number of times from Empire Justice Center. Pam Marin has been a rising and creative voice in our field. She's a mortgage broker with Innovative Mortgage Services, and she is serving the Florida area, but she's also on the Federal Advisory Board on Housing Counseling, and has identified both a deep problem in the mortgage field for people who are returning buyers, and for people who are and a problem with the way the credit report handles this, and in a very helpful way that we think housing counseling can be part of the solution. So we wanted to get these folks on, and let's learn how this all might work in a way that can help the home buyers and help housing counseling. So Pam and Ellie, welcome.
Thank you. Hi, everybody. This is Ellie. I want to first say thanks to Bruce and Matthew for giving us the opportunity to talk about this. So Pam and I met, as Bruce said, as a result of both being members of the HUD Federal Housing Counseling Federal Advisory Committee, and it has been, over the last 6 weeks, Pam and I have spent a lot of time talking about this issue, and Pam has been teaching me and helping me learn what this issue is about, and I can tell you it's been a very informative interaction, and I have learned a lot about how things work on the lending side of life, which I have never really had experience with other than, you know, working directly with homeowners and home buyers. So what we found is that while consumers that engaged in a short sale are eligible under the Fannie and Freddie guidelines to re-enter the mortgage market after 4 years, and in some cases 2 years when there's extenuating circumstances, the way that their mortgage payment history is coded by the credit bureaus causes the automated underwriting system that Fannie and Freddie use to interpret them as foreclosures. I will say, to be clear, that this does not affect those who are applying for an FHA or other government mortgage product. So these are people who are applying for it through the conventional mortgage market. There is some indication, though, that the same is happening for those who went through a modification, or even in some cases sold their property for a profit, paid off all of their arrears and debts, and walked away with some money. It appears that this may be happening to them as well. We've identified 3 problems that create this this credit issue, and we're going to talk about the ways that we think housing counselors can assist consumers who are trying to re-enter the mortgage market or access credit after they have gone through a short sale, a modification, or some other form of loss mitigation. We're going to show you some examples of what to look for, and we'll offer a preface of a more in-depth training that we're going to offer on April 27th, and that's going to be via the Leaders in Housing Counseling platform again. But for today, we're giving a high-level overview, and we're going to leave plenty of time for questions. Next slide. So how many consumers are we really talking about? According, as you can see on the slide here, according to ATTOM Data Solutions, nearly 2 million customers engaged in a short sale or a deed in lieu since January of 2010. As I said, past homeowners are eligible to re-enter the conventional mortgage market 4 years after engaging in a short sale or a deed in lieu. So that means that just over 1 million of these consumers are potentially eligible to re-enter the mortgage market right now. And another 950,000 of them will be becoming eligible over the next 2 to 3 years. So during the financial crisis, housing counseling agencies, you guys ramped up to meet the needs of distressed homeowners. You all sharpened your budget development and your credit report interpretation skills. You strengthened your ability to negotiate, and you learned creative ways to provide needed services for your clients. This means that you all are uniquely qualified to assist the stranded consumers who are going to be looking to re-enter the mortgage and/or credit market. So the next series of slides is going to introduce what to look for and how to address it. And as I mentioned earlier, it's not a comprehensive review, but rather a sort of primer for more in-depth training that'll be done on the 27th for those of you who are interested in really taking this on. Now I'm going to hand over the presentation to Pam, who has been so instrumental in bringing this issue to the forefront. Pam, and next slide, please.
Thanks, Ellie. Here are the 3 targeted problems that commonly show up. Problem 2 and 3 are often the unintended consequence of problem 1. Problem 1, a short sale or modification that is found on a conventional Fannie Mae or Freddie Mac automated submission, is found at the lender end. Most often when this issue comes up, the consumer is either referred to a credit repair company that charges a fee, or the consumer tries to fix it themselves. Typically, these attempts to correct are unsuccessful and can end up creating even bigger problems for the consumers. Next slide. To start, there are some needed tools. Before we go into details, there are documents you should gather and specific credit report criteria you should have ready to assist these clients efficiently with. First, if you have a referral through a lender, have that lender send you the Fannie Mae or Freddie Mac automated findings that shows the loan denial. Also, ask the lender if they can send you the credit report for the home purchaser they are referring. Second, if the lender provides you with the credit report, make sure that all 3 bureaus, Experian, Equifax, and TransUnion, can show up separately for the affected mortgage account. In case you need to pull the credit, make sure that your credit report has the ability to show all 3 bureaus, again, Experian, TransUnion, and Equifax, for the problem mortgage account. If your credit report does not allow you to see these 3 bureaus separately, contact your credit reporting agency and ask them to add this option. We will show you what this looks like in an upcoming slide and can answer questions about getting this option on your credit report during the presentation. Third, make sure that your client brings proof of their past short sale, such as the approval letter from the short sale lender and their HUD-1 closing statement. Also ask them if there was a deficiency that was paid after the short sale closed or a modification, and get the documents that prove the beginning and end dates for this. Make sure the affected client comes with an explanation of their hardship or the reason that the short sale or modification occurred, and have them describe any measures they took to try and stay put in their home. Next slide. Fannie Mae and Freddie Mac automated underwriting systems are currently utilized by lenders only. but you need to know what it looks like when we pull an automated report and where the denial and detail of the denial can be found. Above are snapshots of what a Fannie Mae and Freddie Mac denial look like through the automated underwriting systems. If a lender calls you with a denial for a past short seller that appears as a foreclosure in the automated underwriting system, this is commonly the first place they notice it. Matthew, if you could put the arrow on the refer with caution on the left Fannie Mae desktop originator that's highlighted, it's highlighted in yellow, refer with caution. That's where the denial occurs on the Fannie Mae desktop originator or underwriter. And then if you go over to the right to the Freddie Mac loan product, there you go. That's where the caution appears. A denial in either Fannie Mae or Freddie Mac will have the word caution in it. Look at the highlighted refer with caution on the Fannie Mae desktop originator and caution at the top of the Freddie Mac loan product advisor findings. The Fannie Mae denial on the left was actually for a borrower who did not have a short sale, deed in lieu, or a modification. They did have a mortgage payment that was over 180 days late, but they sold the home at a profit. Recently, this consumer was denied a car loan due to these late mortgage payments showing up as a foreclosure in both of the automated underwriting systems. The Freddie Mac,
I want to interrupt you just for a second, Pam. So if you see on the Fannie Mae desktop originator example, Matthew, if you bring the cursor down all the way to the bottom, you can see where it says in number 4, desktop underwriter has identified a foreclosure that was reported on the credit report. I just wanted to highlight that so that people saw it.
Yeah. And the basic, I'm sorry, the okay, and if you go over to the right, Matthew, go down to almost to the bottom where it says 13, and that says recent foreclosure, significant derogatory appears on credit report. That appears on every single Freddie Mac loan prospector finding when the system thinks that a short sale or a modification is a foreclosure. Unfortunately for both of these clients, without intervention, they would not be able to secure a conventional Fannie Mae or Freddie Mac conventional mortgage.
So can you tell us what happens when somebody, Pam, when somebody goes to their lender, they had a past short sale and it's been, let's say 5 years, for instance. They go to their lender, they apply for a mortgage so that they found another house that they want to buy, their income is back, they want to try to buy another house, they think that they have been long enough from the short sale, but they go and the loan officer says, you're denied because it looks like there's a foreclosure on your case. So what happens to those people essentially as far as the mortgage is concerned?
Okay, most of the time the lender tells the consumer they're denied and to go get the problem fixed. The consumer either tries to fix the problem themselves or they go to a credit repair company. The most common attempt to fix is a dispute. Upon putting the dispute on the account, they also open account information, which is how another problem will show you the date reported becomes more current, or often the borrower either gets put into a higher interest rate portfolio conventional loan or an FHA loan that allows for a manual underwrite. Fannie Mae and Freddie Mac conventional loans do not allow for a manual underwrite. In most cases, the borrower never fully understands why they were turned down in the first place. Next slide.
Well, before we
you can have a manual underwrite, but most lenders don't like to do them. But,
no lenders will do them, and here's the reason why. There is no reps and warranties on a manual underwrite, and the yield that the lenders get for those loans is not enough to justify the risk of doing a manual underwrite. We have scoured the United States. There is no lender that will do a manual underwrite that we can find on Fannie and Freddie conventional loans.
So I think before we jump to the next slide, I do want to just kind of poll Matthew to see if there's any questions that we should be looking at to answer.
There are a couple, but I think you just covered them. I'll just quickly, they're essentially the same thing, but I thought a refer with caution meant it could go forward with extra review. You're saying refer with caution is a denial. So I think you addressed that pretty well.
Okay.
And that's essentially the
So,
same other question.
Okay.
Next slide.
So here's what a tri-merge credit report looks like, and where you see the detail for all three of the bureaus, Experian, TransUnion, and Equifax. The top line, the top mortgage credit line shows Flagstar Bank, the problem short sale account. This is what we as mortgage lenders see on our hard pull credit report that blends all three of the credit bureaus of Experian, TransUnion, and Equifax into one. On the far right, you will see under paid foreclosure a link to the three credit bureaus, which when open shows the detail of all three of these bureaus individually. From this detail that is below under the three bureaus, Experian, TransUnion, and Equifax, you can see which bureaus are reporting which problem. Let's look at the Experian one first, the top of the three. Go all the way to the right where you see numbers highlighted under the payment history. Commonly, when you see a number greater than a 4 in the mortgage payment history, the mortgage credit will show up as a foreclosure. Now let's go to the Equifax, which is at the bottom of the three. The reported date that is outlined in red shows May 2016 and not the August 2012 on the date reported for TransUnion and Experian directly above. Earlier we talked about getting short sale documents from the consumer like a HUD-1 or a closing statement, but even without having those documents in front of you, a date reported that is different than the other date reported on the other trade lines is a red flag. The date reported is the last date that anything was done on the account. The discrepancy here on a more recent date than the short sale date indicates that either a dispute was filed on the account or the account could be a deficiency that was paid off or closed after the short sale close date. A deficiency is a new loan put in place by the lender after a short sale closes to recoup an additional amount of the mortgage not paid in the short sale. So here, if it was a deficiency, it is likely that the homeowner completed payment on the loan or the remainder was forgiven in May of 2016. The reason why that's problematic is that 516 just put that past short seller who really had their short sale in August of 2012 within that 4-year wait time frame that's required. You have to have that 4 years past your short sale in order to get a new mortgage. So it just made this borrower exempt because that 516 date is within that 4 years. Next slide. And if you've got questions,
Yep.
feel free to jump in here.
Yeah, so if you could maybe, so someone asked about if you dispute something on your credit, it shows recent. If you could just maybe elaborate on that a little bit.
If I think that the next slide is going to show you that. If you go to the dispute, there you go, dispute of account. In this example, this one is only showing 2 of the bureaus, but just to let you know, you can get the 3rd bureau by contacting your credit reporting company. So here you can see the 3rd issue, which is the dispute, and the dispute commonly shows up in the remarks section. For TransUnion, it's the underlined dispute word under remarks. And the dispute often occurs because the borrower has commonly found that there's already a problem, that either their short sale credit was coded as a foreclosure, they know of somebody that had a short sale, and they're wanting to make sure their credit is okay in order for them to attempt a mortgage to go ahead, and the dispute occurs when they find this problem for the first time, commonly. It is often put on there by a credit repair company, or it can also be put on there by the homeowner themselves.
So can you tell us, Pam, though, what happens, how does this dispute word under remarks have an effect on somebody's ability to apply for a conventional mortgage?
A dispute basically hides the credit underneath. So the Fannie Mae and Freddie Mac automated system think that there is no dispute. However, when we run it through the automated system, either the automated systems will say, if there is a dispute on the credit, please remove it, or the underwriter requires for us to remove it. When we remove that dispute, the old problematic credit comes back, the automated system denies the loan, and the credit scores plummet. And this is incredibly problematic when the borrower is in the midst of a contract, where the only option that could be attempted to try to remedy this is a rapid rescore through a credit reporting agency that is costly and must be paid for by the lender. And I'll tell you, the reason why this is a common occurrence, and a major reason that loan originators who have experienced this don't want to assist these consumers until the problem is fixed, is because the lender ends up having to pay for this. Having the pre-purchase option that we would like to show to the housing counselors to correct this problem ahead of a contract is a greatly needed service.
So I just kind of want to clarify to make sure that I understand what you're saying. So what you're saying is somebody who did a past short sale or had a number of payments late of at least 120 days or more, they go at some point to try to re-enter the mortgage market because they think they're eligible to. It's been 4 years, they want to buy a house. They go to a loan officer, the loan officer runs them through the automated underwriting system and says, hey, there's a foreclosure showing up on your report. And the home buyer says, I didn't have a foreclosure, I had a short sale. So the loan officer says, well, you need to dispute that then. So they either on their own, as the consumer, file a dispute, or they engage with a credit repair agency, because often a loan officer will refer to a credit repair agency that charges a fee, and they file the dispute. So now here the consumer thinks, I'm all set, I've filed a dispute on my account, it was resolved, they took care of it, they removed that item from my report. The consumer goes back and says, okay, I resolved it. It gets run through the automated underwriting system again, and the loan officer comes back and says, you have to lift the dispute. The dispute can't be there. So the consumer says, okay, and they try to lift the dispute, but once the dispute is lifted, that mortgage that is being reported as 120 days late and showing up as a foreclosure pops back up again, and they're right back where they started.
Exactly.
So that's what happens. Okay.
Yep.
Are there any questions? Does anybody have any questions about that, Matthew?
So someone asked, can a consumer dispute something that occurs well after the last activity was reported, and then pointed out an example here that it was last reported in 5/13, but the last activity was 5/10?
No, once the dispute, or I'm sorry, once a date reported date is on there, it's going to stay. If they dispute it, what's going to happen is the lender's going to require that the dispute be lifted, but the date reported is still going to be the problem, and it will stay.
Great, thanks. Sorry.
Yeah, that's okay. And I think that this is a good time to go to the next slide, because we're gonna talk now about some of these things that people are asking about, the specific problems, and then what Pam has discovered are ways to resolve them.
So on April 27th, we will provide more in-depth training to address 4 specific problems and their solutions thus far. Problem one,
Okay,
the past short...
Pam, let me just jump in here. So
Sure.
what we're doing is we're going to present the problem and kind of the broad view of this and what the opportunity is for counseling agencies. And then for those that really would like to learn all the mechanics, Pam and Ellie are going to do a second workshop or webinar in 2 weeks, and we'll send out the link and people can get registered for it. But it'll be longer and even more depth on this, but it'll give you the tools that you could implement this in your own office.
And just to let folks know, we circulated in the chat box, there's should be a live link that you can click on to register for that call on the 27th.
Exactly. So I just want to say that for an example in problem one here that Pam is about to talk about, you can see that one of the solutions is a Fannie Mae workaround. We aren't going to get into the detail today about what that Fannie Mae workaround exactly is. There's some steps and it's relatively time consuming. That's the kind of thing that we'll get into on the 27th.
Right, and the first problem is past short sale credit appears as a foreclosure in both the Fannie Mae and Freddie Mac automated underwriting system. One of the solutions is a Fannie Mae workaround. There is no workaround in Freddie Mac. Another solution is to submit a complaint to the Consumer Financial Protection Bureau. The problem number 2 is an account in dispute. And the only thing you can really do on that, other than submitting a complaint to the CFPB, is to work with the creditors to have that account removed altogether. Next slide. Problem 3 is the incorrect date reported. When a consumer or credit reporting credit repair company attempts to get an account updated, trying to solve a problem, and they cause the date to fall within the minimum 4-year required wait time frame for the new conventional mortgage. The solution to that has been to get a lender letter to fix the erroneous date reported or to submit a complaint to the Consumer Financial Protection Bureau. And on problem 4, which is a loan modification or where even a mortgage delinquency went past 120 days late and is being credit coded as a foreclosure, the Fannie Mae workaround worked on that problem. And it even worked on modifications. And you can also submit a complaint to the Consumer Financial Protection Bureau. Now you're seeing a pattern here on all 4 of these to submit a complaint to the CFPB. Here's why that works. The CFPB submit a complaint requires that the lender respond within 15 days directly to the CFPB. And if the lender does not provide an adequate change, the consumer is able to take that complaint further. That was a fluke when we were trying to find some other solutions, and the Fannie Mae workaround was attempted the first time in November of 2013, and it didn't work, and the wrath of the mortgage industry came down on us. Out of frustration, we tried the Consumer Financial Protection Bureau submit a complaint, and that actually worked. We also found in doing that it was possible to change the credit code that was being placed on the short sales as a foreclosure. It was possible to change the code because it was done in many cases. So again, these solutions that we are sharing with you briefly above are to known problems that would be incredibly helpful if applied before the affected consumers attempted a home purchase. Because of this, there's a great opportunity to connect the consumers who've had a short sale modification or excessive mortgage lates with loan originators, realtors, lenders, and credit reporting agencies, who are the first professionals to work with these consumers when they can re-enter the housing market. So this is a great opportunity for the housing counseling industry. Next slide.
So the big question, how do you find these clients? So housing counselors usually assist either first-time home buyers or homeowners that are in trouble. So we're less likely to see those attempting to re-enter the housing market. But as I outlined earlier, due to the housing crisis, housing counselors are uniquely qualified to assist these stranded consumers attempting to re-enter the mortgage market. And many of you already have some strong connections with real estate agent, banks, and independent mortgage brokers. You know, in my conversations with Pam, it became clear that you should be encouraged to reach out to these connections and discuss a potential partnership that would benefit them, your consumers, and your organization. And we're also working to educate other stakeholders about the issue and about how housing counseling agencies can help.
And the intent of involving the housing counseling industry with the real correction for these credit issues is to offer a pre-purchase service that fixes the problem before the affected consumers enter a time-sensitive purchase contract. It became very apparent at the beginning of when Ellie and I were talking why this is such a good fit. Lenders are driven by contract deadlines and getting a clear approval for a mortgage. Housing counselors are driven to prepare consumers for successful home ownership. Promoting that your industry, the housing counseling industry, can help with this problem prior to these affected consumers purchasing a home will not only be received as a great service from the affected consumers, but also from the loan originators, realtors, lenders, and credit reporting agencies that are seeing this on a day-to-day basis. I already have realtors, loan professionals, and credit reporting agencies that are waiting for this training to come out.
So I'll kind of add a little bit to what Pam said, in that when she and I were first talking about this, she made it clear that when, you know, loan officers they are about the numbers of people that they can get into, you know, through a mortgage process and to closing, right? So when they encounter a consumer who has, you know, kind of a hairy issue with their credit history, they're not inclined to spend a lot of time working on it. They're more inclined to say, here's where you can go to get this fixed, and then come back to me. And what we're hoping is that the place they're going to say that they're going to send homeowners to get it fixed is to housing counseling agencies, rather than to credit repair agencies that charge a fee and don't necessarily resolve the problem. And also, housing counselors are going to be working with that person on the whole home buying process and the whole mortgage application process. So that's where we hope that the benefit will be seen for everybody. Next slide.
That's right. I wanted to also say there too that you as housing counselors could reach out to your past clients who've had a past short sale or modification, and you know, connect with the lender who can run them through the automated systems. And if your past client is having this problem, this is a client that you could work with that realtor or that lender to get them home ready for their next purchase.
It's a very good idea.
So, go ahead.
No,
Bruce, did you want to say something?
I'm just saying that's a very good idea.
Yeah. So, so a couple, you know, Bruce talked a little bit earlier about, thankfully, the CFPB came out and said, you know, it's okay. Housing counseling agencies can indeed charge a fee for service. Just, you know, make sure you follow certain rules, which we're all following already because HUD requires that we keep open and provide multiple options. So this is not news for housing counseling agencies. So, I mean, one option is to just have the affected consumer pay for the service right up front. And in talking with Pam, it seems like $350 to $500 is a reasonable amount to charge, depending on maybe your location and maybe the type of service that you provide, and that a referring lender can provide a credit back to the consumer toward their closing costs upon a home purchase contract.
And Ellie and I talked about that credit and what that is. Here's the difference quantified in dollars. The cost of this service divided into the loan amount is the percentage of the additional cost to the buyer. A credit for this cost, if paid by the lender, could be compared to the difference in cost of 1/8% in interest rate if the affected consumer needed that credit in order to cover this. But I think that affected consumers will pay for these services up front, and here's the reason why. And I've experienced this for the last 5 years. There are multiple problems for consumers who try to get a mortgage when they're eligible again after a short sale or a modification. And it should not be this hard when the guidelines are in writing that state these people should be able to get a mortgage, yet it is incredibly problematic. Homeowners that have this problem don't like to talk about this time in their life, and especially not in a public forum. So having the ability to clear this up with one-on-one counseling and knowing they are set for a new home purchase will be a huge relief to them.
One of the things I want to say is that's right, Pam. That typically people don't want, not only when they're in it, they don't want to talk about it, but certainly since it happened in the past, why it's horrible that it's going to have to come up again, right? So making it as easy as possible is beneficial to them, and it's beneficial to the lender, because then the lender gets somebody who's taken care of in a quick fashion and can then move through to the final stage. But the other thing that that really concerns me is that as housing counselors, we've been telling homeowners that a short sale or a deed in lieu is better than a foreclosure. But what we're finding is that in many cases that may not actually be true, which is really disconcerting and upsetting. Because as we know, a short sale or a deed in lieu is not an easy process. So hopefully this is something that we can look at.
And you know what, Ellie, it just dawned on me that people are probably thinking, why are they not bringing up foreclosure? Here's the difference. On a short sale, you should be able to purchase another home, get another conventional mortgage after 4 years. If you've had a foreclosure, you wait 7 years. What we're doing with this, what this problem is affecting, is that these short sellers are having to wait 7 years to get another conventional mortgage. And what that does is if they're in a contract, what it ends up doing is it pushes them into either having to get an FHA loan, which is not bad, but they have to pay mortgage insurance even with 20% down, or they end up having to get a higher rate portfolio loan. So not only do they think, and it's in writing, that they should be able to gain access back into the housing market at 4 years, they have to rush with a signed contract with costs for appraisals and home inspections and deposits already out, and often have to take a loan they didn't sign up for. So by you helping these people pre-purchase, that's where the value of the service to the whole mortgage and real estate industry is.
That's right. And as Pam mentioned, that these are homeowners who are usually willing to pay to have the credit issue properly cured. Pam has talked to me about how many moderate to high income home buyers she sees who have this issue. Again, I'll point out that this is an issue that we are finding is also present for people who have a modification, and the reason is to do with the fact that if somebody went delinquent 120 days or 180 days or more, or no, it's 120 days, right, Pam?
Yes,
120, right, 120 days or more, that it is just kind of, for lack of a better word, automatically interpreted as a foreclosure, because there's no code that cues the system that it is a short sale rather than a foreclosure. So we're seeing, or that it's a modification rather than a foreclosure. So we're seeing people with modifications. And although they may not be trying to re-enter the mortgage market necessarily, because they got a modification, they're happy with the home that they're in, they may be trying to access an auto loan or access a personal loan to cover some kind of repairs that they need on their property. So that would affect their ability to access that credit. I think, unless there's something else you wanted to add before we open it up for more questions, Pam?
Nope.
So are there any other questions, Matthew?
Yeah, just so the first, does this apply for VA loans? Maybe you could just run through quickly what this does and does not apply to.
No, it does not apply to VA or FHA loans. The benefit of FHA and VA is that they have a secondary automated system that runs along with the Fannie and Freddie system. It's called Total Scorecard, and what that does is it doesn't turn them down on the findings, but it does state that there appears there may be short sale or foreclosure on the credit. Please check it out. And the FHA and VA can also do the manual underwriting where the underwriter can see that it's not actually a foreclosure and they can sign off on the loan. That's not available in conventional. And let me preface that. It is available in the written guidelines of conventional Fannie and Freddie that a manual underwrite is acceptable. We just can't find any lenders that will do it.
All right. So this person said, do I understand correctly that there's no expectation that the automated underwriting system will be fixed? Why isn't there sufficient support for that to happen? After all, lenders are losing out on a lot of loans.
The automated system was supposed to be fixed for Fannie and Freddie back in 2013, and Fannie implemented a change. The problem continues to be that Fannie and Freddie are saying that they are taking the code directly from the three bureaus. The bureaus are saying the problem is in the Fannie and Freddie automated system. However, I will tell you that as we speak, we have a group of folks that have seen this time and time again, including the largest servicer in the United States, we are now actively looking at hoping to get a code change or acknowledgement of this with a quicker, with a code change. However, in the meantime, it's not just this credit code that's the problem, it's the disputes and the date reported as well. And our hope is that we can probably get the housing counseling industry up and running on helping these folks potentially quicker than we can do those other fixes.
And I just want to add that Pam has been working really hard since before 2013 to really kind of get this out there and get attention paid to it. And some attention was paid in 2013, and everybody kind of thought that the problem was solved. But Pam has discovered in the last year that the problem really isn't solved, and it's becoming more of an issue given that more homeowners who went through short sales are now trying to re-enter the mortgage market.
All right. So this is going back to Pam had talked about using the CFPB complaint database. So this person said, it's my understanding that CFPB didn't work on specific cases, that they really just kind of looked for patterns and did something if there was some critical mass. So could you just kind of clarify that? They were surprised that it sounded like you had folks who got helped individually.
Yeah, and every customer I've sent there has gotten individual help. And what we're going to show you on the April 27th session is exactly what to put in the 5 screens that the homeowner will see when they submit a complaint, and exactly what to put, the verbiage to put in there. And what this does is the lenders that it goes to they have to respond within a period of time. And commonly, the answer comes back in 3 to 5 days, but they are all individual complaints. It has worked even alongside us getting other assistance. So I strongly recommend that. I just want to be for having that.
And I want to be clear that what Pam is saying is that there's some specific ways to submit the complaint, some specific wording to use in order so that when CFPB says to the bank or the lender, hey, here's a complaint, you need to address it, the lender sees some very specific things that they can address.
Right.
So it's not
right.
that CFPB individually dealt with it. Every complaint gets referred back to whoever the complaint is about for some kind of response. So.
Right.
All right, thanks. So we're ready to. I think there's a number of questions on kind of timing that maybe I'll just ask all of them and let you all just respond. If a foreclosure, if a quote-unquote foreclosure is showing up on the credit report, but it was truly a loan modification, how long does the new buyer have to wait again? How long does the process take to correct before the credit report shows the correction? How long does a client wait if they did a deed in lieu? Does a client have to wait 7 years if they had a modification done? I thought those were all roughly the same question, but I could be wrong.
Time frames. They're basically the modification question of time to wait. Frankly, I will get that answer for you. I don't have that. The deed in lieu should be 4 years, the same as a short sale, and bankruptcy 4 years as well.
And foreclosure is 7.
Yeah.
And what I will say about modification, and this is my assumption, and again, Pam may find something different, is that once you've had a modification, it's considered a cured mortgage, and that then you just need to have 12 to 24 months of on-time payments, essentially.
Yeah.
But if Pam finds something different, we'll get that to Bruce, or if Bruce knows something different.
Good. Well, let us know when you dig it up, and well, we could save that for the 27th.
27th.
So thank you very
yes.
much. We're a little bit past time, but this was excellent. And if everybody can hang on for just another quick minute, we'll run through a couple quick things. So we'll have next week on the 20th. So we have the 27th on. There'll be a follow-up on this, and the session for next week will be on the alternative loan product to a payday loan that the CDC of Brownsville and the CDCs of Texas have put together. It's quite an ambitious program, but it's one that they're looking for housing counseling agencies that might adopt it as a consumer, to meet a consumer need, but also as an income producing new line of business. I think this will be also a very exciting workshop, and definitely you should register for the call and join us. And then the following week on the 27th, we're going to do a deeper dive into what the solutions are and answer some of these questions, and might be also worth talking a little bit about how to market this in a way that would bring these clients to the counseling agency so that counselors could actually start doing these cases. But all very, very helpful, and we will move on to the next quick thing is that just a quick reminder to be sure to join NHRC if you haven't already. We're continuing to produce these kind of things for the counseling industry, and we really rely on membership dues. It's a fifth of our budget and a major part of it, and it gives us some of the independence that we really need to do the work that we do. Really appreciate the fact that a number of new groups have joined in the past few months, and I know that it's a hard time for groups, and really appreciate that people are making commitments like this, and hope that if you haven't joined already that you will right now. And you can always go to our website, and upper right hand corner there's a or actually I guess in the toolbar there's a join link, and you can link to it, or you can email me and I'll be glad to send you the information. All good. So excellent, everybody. Let's plan on being together again next Thursday, and then the week afterwards as well. And on the email that went out today, there are other workshops that you can sign up for now and get on the schedule for. So I saw some people have gone through and clicked all the ones they want to attend. But we'll do these through May, and if you've got a program that's a real income generating program that it would be good to share with other counseling agencies, please let me know. We can do more of these, but so far we've got a full slate through May. All right, well, thank you so much, Pam and Ellie. This was terrific, and we'll talk to everybody later.
Thank you.
Thank you.
Bye-bye.
Bye-bye.